What's up, guys? It's me here. So over the past few weeks, I've been getting a lot of questions about dollar cost averaging, otherwise known as DCA, which is an investing strategy that a lot of people have been using in order to buy stocks, ETFs, or mutual funds on a regular basis, usually every week or every month without fail. And the main idea is that by doing so, you're able to reduce your average cost per share while also reducing your risk. But what's interesting is that just because it's called dollar cost averaging doesn't mean that you actually averaging out a lower price. In fact, historically, studies show that lump sum investing tends to do better over time. So let's talk about exactly how that works, whether or not you should be doing this, and if you want to learn more about other ways to make money in the stock market. Alright, so first of all, let's talk about what dollar cost averaging actually is, because there are two main ways that people invest their money. The first way is called lump sum buying, which means you take a large sum of money and you invest it all at once. The second method is called dollar cost averaging, where you invest smaller amounts of money over a longer period of time. And the main benefit that many investors claim to see with dollar cost averaging is that you're able to buy more shares when the price is low and fewer shares when the price is high, thereby lowering your average cost. And to some extent, yes, this is true. However, the problem with dollar cost averaging is that it assumes that you know the future, which is impossible. For example, imagine you invest $1,000 into a stock at $10 per share, which would give you 100 shares. Then imagine you invest another $1,000 a month later, but this time the stock price is now at $5 per share. Well, now you have twice as much money invested, but you own twice as many shares, meaning that your average cost per share is now $5, which is half of what you paid for the first one. However, that's not always the case, because even though you bought more shares when the price was lower, you also bought fewer shares when the price was higher. Therefore, you end up with a sort of average price somewhere in between. The good news, though, is that since dollar cost averaging involves investing smaller amounts of money on a regular basis, it can help reduce your overall risk simply because you're not putting all of your money into a single investment. Instead, you're gradually buying in over time. But despite the benefits of dollar cost averaging, studies show that lump sum investing actually yields higher returns 75% of the time. And when you factor in fees, trading costs, and taxes, dollar cost averaging becomes even less efficient. Of course, this is all just hypothetical, and there's no guarantee that one strategy will outperform the other. So it really just depends on a variety of factors, like how long you plan on investing, what your risk tolerance is, and most importantly, when you plan on selling. Personally, I fall into the belief that the best time to sell is never. And if you're interested in learning more about that, feel free to check out my video on permanent portfolio. Otherwise, if you enjoyed this video, make sure to subscribe. And as always, thank you so much for watching, and until next time.